Welcome to the Deep Dive. Today we're digging into the latest from Canadian Solar. We're looking at their first quarter 2025 earnings call.
Yeah, it was a pretty packed call. It gave us a real insight into how a major player, in solar and storage is handling things right now.
Definitely some choppy waters, as you said. But they're also making these big long-term bets. So let's try and cut through the numbers, the jargon, figure out what really stood out.
Exactly. It wasn't straightforward. You see a company facing, intense market pressure, lots of policy uncertainty, especially in the U.S., but also, strategically trying to position itself for what comes next. So, yeah, we'll hit the headlines, dig into the financials, look at the different business segments.
And what management's actually seeing down the road.
Right.
Okay, so let's kick off with that quick snapshot. Q1 2025 headlines. Module shipments, 6.9 gigawatts.
Yeah, just a touch above their guidance, actually.
Okay, and energy storage deliveries.
849 megawatt hours, right in line with what they expected.
Revenue came in at $1.2 billion. That was at the high end of their range.
It was. And the gross margin, 11.7%, that also modestly beat expectations.
So far, sounds pretty decent, right? But here's the catch. They reported a net loss to shareholders, $34 million.
Yeah, or 69 cents per share. And management gave a few key reasons for that, even with, solid revenue.
Like what?
Well, one was lower contributions from storage deliveries compared to maybe some stronger past quarters. Another was costs tied to transforming their recurrent energy business, the project development side.
Okay.
And then finally, some intercompany eliminations related to projects they're building for themselves, basically.
Right. So the takeaway seems to be, even when sales hit the mark, profitability is getting squeezed. Mix shift, internal stuff, the broader market.
Exactly. It tells you the volume is there, but turning that volume into actual profit, that's the challenge right now.
All right, let's peel back the onion a bit then. Those Q1 financials, that 11.7% gross margin you mentioned.
Right.
It was down sequentially, right?
Yeah, down 260 basis points, so 2.6 percentage points from Q4. And the main driver there, like we said, was fewer energy storage shipments in Q1.
And year over year.
Bigger drop, 730 basis points or 7.3 percentage points. That was mainly because module average selling prices, the ASPs, were lower, just selling panels for less than a year ago.
Makes sense. But on the plus side, operating expenses were down year over year.
Yeah, down 4%. They said lower shipping costs, keeping things tight. They did mention some non-recurring charges in the prior year, made the comparison look a bit better, but still, real savings there.
Okay. One number that kind of jumped out at me was net interest expense, $28 million.
Right. Way up from $9 million last quarter and less than $1 million a year ago. They're calling this quarter more normalized. Seems like prior periods had some extra interest income boosting them.
So $28 million is maybe closer to what we should expect going forward.
Feels like it, yeah.
They also had a $14 million foreign exchange loss, mostly dollar weakness, but they did get an accounting boost, HLBV.
Ah, yeah, the hypothetical liquidation at book value. It's a complex U.S. tax equity thing. Gave them a positive $26 million impact, or $26 million impact, or 0.38 ERTS a share. Comes from how they account for benefits on operating projects under these U.S. deals.
Got it. And cash flow.
They actually used cash in operations, $264 million outflow, mostly tied up in building inventory and investing in project assets.
Which pushed total assets up to $13.9 billion. Investing for the long term, they'd say.
Right, and Q1 CapEx was $256 million, most of that going towards those U.S. manufacturing plants they have.
But they're sticking to the full-year CapEx plan, around $1.2 billion.
Yep, outlook unchanged there.
Okay, and they finished the quarter with $2 billion in cash, but also $5.7 billion in debt. Reflects all that investment, I guess.
Exactly. So that's the financial backdrop. Now let's get into the business engines, starting with CSI Solar, the manufacturing and storage solutions part.
Right. Module shipments there grew, didn't they?
Yeah.
9.4% year over year.
They did, and slightly beat their own guidance. They said part of that was a bit of a demand pull forward in China ahead of some new policies starting June 1st.
Interesting. But the margin in that segment?
That went down. 640 basis points quarter over quarter, so 6.4 percentage points lower.
Ouch. Why such a drop?
Well, partly those lower storage shipments again. Also, some VAT changes in China kicked in and slightly higher manufacturing costs in Southeast Asia as they, ramp up that blended global supply chain.
And they still made an operating profit.
Just barely. $2 million operating income for CSI Solar.
Okay. And it sounded like U.S.-China trade stuff is really top of mind for them.
Oh, absolutely. Management really stressed how vital U.S. energy storage projects are. Huge investments, years of planning, and the U.S. is like upwards of a third of their expected storage business this year.
So the tariff talks are a big deal for them.
Huge. They said they're working closely with customers to manage the risk, and they feel their global manufacturing footprint helps. Beyond the planned Kentucky facility, they have cell manufacturing and suppliers outside China lined up, ready to go starting in 2026.
So offering flexibility for customers worried about tariffs.
That's the idea. And they also mentioned global demand for storage is actually really strong.
Yeah, the pipeline number was huge, wasn't it?
Record high, 91 gigawatt hours as of March 31st. And that includes $3.2 billion in contracted backlog already signed.
Wow. That's significant future revenue locked in for storage.
Definitely. They highlighted a big project win to 912 megawatt hours in Chile with a partner called Perón. Really shows why storage is booming grid reliability and making renewables work better.
Okay, let's switch gears to Recurrent Energy. That's the project development and increasingly the IPP arm, right? Independent power producer.
Exactly. Their Q1 revenue was $125 million. Pretty solid gross margin, too, 18.6%, helped by some project sales in Latin America.
But they had an operating loss.
Yeah, $12 million loss. That's down to the costs of building out the platform, the team, the capabilities, and scaling up that IPP portfolio, the projects they plan to own long term. It's a big transformation they're executing.
And they've got a lot under construction now.
Yeah, 1.2 gigawatts peak of solar and 1.4 gigawatt hours of storage spread across Europe and the U.S.
Any highlights there?
Well, in Italy, their 35 megawatt Montalto solar project started operating in January. Got a decent PPA with Axpo, and it's one of the first co-located solar and battery projects there. The battery part actually won a 15-year fixed payment contract. That's under construction now.
Interesting. And in the U.S.?
They locked down financing for the Fort Duncan project in Texas. That's a 200 megawatt hour merchant storage project.
Merchant meaning no long-term contract, selling into the market.
Exactly. They flagged it as a key win, showing they can finance these more market-exposed structures. It's built and just getting commissioned now.
And to fund holding more projects themselves, they got new financing.
Yep. A $450 million multi-currency credit line. Gives them flexibility as they transition more towards being an IPP, holding assets for recurring revenue.
Makes sense. And given all the U.S. policy worries, are they doing anything to protect their U.S. projects?
Yeah, they mentioned safe harboring equipment, basically buying key stuff now to lock in eligibility for tax credits under current rules, even if the projects aren't finished. They think recent trade talk progress won't really impact these specific projects much.
Okay. And their overall pipeline is still massive.
Huge. 27 gigawatts solar, 76 gigawatt hour storage total. The stuff closer to reality, with grid connection secured, is 9 gigawatt solar, 16 gigawatt hour storage. That's excluding what's already running.
But finding good spots is getting harder.
Yeah, they admitted that. Easy land with cheap grid access is scarce. So they're focusing on core markets, US, Europe, and careful greenfield development elsewhere.
All right, so what was management's overall tone looking ahead?
They were pretty blunt, actually. Expect 2025 to feel a lot like 2024. Challenges like overcapacity, tough market, price pressure, competition, plus all the tariff and policy headaches raising costs.
But they're still bullish long term.
Oh, yeah. Confident in the long run, still investing, especially in storage and U.S. manufacturing.
How are they navigating the near term then?
Strategy is key. Focus on profit, not just volume. That means pulling back a bit in less profitable markets, leveraging that blended supply chain, and really pushing bundled solar plus storage sales. They see that as a major advantage and profit source. Plus, keeping a tight grip on OPEX and CapEx.
The CEO, Dr. Kuo, had a strong message about the industry's future.
He did. Framed it as, does this industry still have a bright future? And his answer was a clear yes. Pointed to rising electricity demand globally, the huge impact of things like AI creating an energy gap.
And solar, especially with storage, being a fast solution for that.
Exactly. He emphasized their track record navigating tough times.
Products too, right?
Yeah, some interesting stuff. Anti-hill technology for panels in Australia sounds like weather protection. New high-power Topicon module for utility scale, up to 660 watts, better efficiency.
And on the storage side?
Solbank 3.0 plus, longer lifespan 25 years, almost no degradation early on, more cycles, better overall energy throughput, and their residential EP cube storage system keeps winning awards and gaining traction.
Okay, let's get to the guidance. What are they forecasting for Q2?
CSI solar module shipments, 7.5 to 8 gigawatts. That includes about 500 megawatts for their own project.
And storage deliveries.
Big jump expected in Q2, 2.4 to 2.6 gigawatt hours.
Which drives total Q2 revenue up to $1.9 to $2.1 billion.
And the margin, that was the eye-opener, 23% to 25% gross margin. Huge improvement guided for Q2. And they explain why. It's mostly that big surge in storage shipments, which carry good margins, plus a significant one-time boost from deconsolidating a U.S. storage project.
Ah, right, that deconsolidation piece. Let's make sure we understand that. It's an accounting thing.
Exactly. When this U.S. project hit commercial operation, the accounting rules meant they had to deconsolidate it. When that happens, the profit margin on the CSI solar gear already installed in that project, which was previously hidden because it was an internal sale, gets released or recognized.
So it makes that internal profit visible on the books.
Right. And they said this specific event gives them a one-time bump of roughly 5% to 6% to the gross margin just in Q2.
Okay, so important context. That high Q2 margin isn't all ongoing operational improvement.
Correct. They were clear it's a one-time Q2 thing tied to accounting standards when the project reaches COD and risks transfer.
Got it. Now, what about the full year 2025? They updated that guidance too.
They did, and this is where you really see the impact of those challenges. Full-year module volume guidance is now 25 to 30 gigawatts. That includes about 1 gigawatt for internal projects.
That's a reduction from before, isn't it?
It is, and they explicitly said it's a strategic choice. Reducing exposure to less profitable markets outside the U.S., U.S. volume expectations are apparently unchanged.
And full-year storage shipments.
Also adjusted. It's now conditional guidance of 7 to 9 gigawatt hours, including about 1 gigawatt internal. That conditionality, that range, specifically reflects the uncertainty around U.S. volumes due to trade talks and policy.
So lower volumes overall mean lower revenue guide.
Yep. Full-year revenue now guided at $6.1 to $7.1 billion. And they stress the range is wide because of pricing volatility and all that policy uncertainty.
Okay. The Q&A must have been interesting. What came up? FEOC?
Oh, yeah. Foreign entity of concern. That new draft bill from the U.S. House Ways and Means Committee. Management view. It's just a first draft. Expect changes.
It matters because
if the current language stuck, it could mess with the ownership structure for their U.S. plants. Indiana sells, Kentucky storage.
Right.
Canadian Solar is Canadian, but CSI Solar, which owns the plants, is structured under Chinese law, and Canadian Solar owns 65% of it.
Tricky.
Very. They said they're ready to change the structure if needed, but it's a balancing act with IRA timelines. They hope the final bill is supportive.
What about balance sheet leverage?
Recurrent's leverage will creep up a bit as it builds out its IPP portfolio. CSI Solar aims to keep its leverage similar.
And they confirmed the module volume cut was strategic, not just weak demand.
Mostly strategic, yes. Pulling back from less profitable non-U.S. markets, storage range is all about that U.S. trade uncertainty.
And you talk about potential changes to U.S. tax credits, like the ITC or PTC?
Yeah, that came up. If the requirement shifted from starting construction to when a project is placed in service, that could be a huge hit. Hundreds of millions, potentially. But they also noted the ITC has been extended before, and the industry adapts. Project economics still look good, they argued.
And circling back on that Q2 margin jump, they confirmed the drivers.
Confirmed strong storage margin, over 20%, plus that big volume increase, and the one-time 5-6% boost from deconsolidating that U.S. storage project at COD. Purely accounting standard-driven release of prior intercompany profit.
Okay. And there's storage guidance, that 7 to 9 GWh range. What tariff assumptions are baked in?
It factors in the current 2-year tariff holiday ending and the uncertainty after that. They mentioned many storage contracts have clauses to handle tariff changes, protecting margins somewhat. But crucially, they're flexible non-China sourcing. That really only helps for 2026 deliveries.
So 2025 still relies mostly on China sourcing for storage.
Largely, yes. And that's partly why some customers actually push projects out to 2026, which is impacting this year's storage guidance range.
Makes sense. What about China demand itself?
Confirmed that Q1 rush before the June 1st policy change. Outlook now depends on how provincial policies shake out. Expect a few months of adjustment, then a pickup, especially for quality storage projects, maybe driven by a shift to more market-based trading.
And the U.S. recurrent business, PPA prices.
They acknowledge TPA prices are rising, and natural gas plant costs are up too, partly thanks to data center demand. Still see the U.S. and Europe as attractive markets. Whether they hold or sell a project when it's ready depends on capital needs and project specifics.
They also shot down a rumor about Ethiopia.
Yeah, clarified a news report wasn't accurate. They're exploring things there, but no commitment made.
Okay, last thing. CapEx and the U.S. plants. Sticking to the $1.2 billion.
Yes. Jeffersonville, Indiana cell plant, phase 1, that's 2 GW. Construction's ongoing, equipment mostly bought and waiting. Phase 2 decision, probably after summer, maybe tied to U.S. budget timelines.
And they're ready to change capital structure if policy demands it.
Ready, but waiting for clarity on the final language. They're spending a bit now to keep design work going, but holding off on major phase 2 equipment orders probably until August or September. Balancing progress with policy risk.
So quite the picture. Solid volume, but profitability squeezed, and big policy clouds impacting the outlook.
That sums it up pretty well. Delivering today, but navigating some serious headwinds that are directly shaping their guidance for the rest of the year.
Right. So given all that, the guided strong Q2 with that one-time boost, but then the lowered full-year outlook because of strategy and policy worries, how might someone, an experienced investor tracking this, think about playing this?
Well, okay, big disclaimer here. Purely illustrative, absolutely not financial advice. We're just talking about the dynamics from the call, right?
Absolutely. Just exploring the information.
So one could think about a strategy trying to capture that near-term guided strength, maybe, while hedging against those longer-term risks that clearly impacted the full-year view.
Like a Q2 bounce in policy hedge kind of idea.
Something like that, yeah. The concept might be, say, a short-term bullish position, maybe near-term call options, June or September expiry, perhaps. Betting the market likes the Q2 numbers when they hit, especially that margin print, fueled by the storage volume and that accounting benefit.
Capitalizing on that specific Q2 story they laid out.
Exactly. But crucially, because the rest of the year and beyond looks much cloudier, those policy risks, the storage sourcing issue for 2025 deliveries mainly coming from China, you might layer on a hedge further out.
Like put options. December, maybe even into 2026.
Potentially. Protecting against bad policy news, project delays slipping into 2026 because of sourcing or tariff issues or just broader impacts if the environment turns sour. Remember, that flexible non-China sourcing is mainly a 2026 story for them.
Right. So it's playing the contrast, the specific temporary Q2 boost versus the bigger fundamental uncertainties.
That's the thought process, acknowledging both the new-term driver they highlighted and the significant longer-term risks they also discussed that led to the guidance adjustments. But again, highly speculative, just an illustration based on the call.
Understood. Absolutely not a recommendation, just thinking through the dynamics.
So wrapping up, Canadian Solar's Q1, well, they showed they can move product, hit revenue targets, but profitability is definitely feeling the heat from the market, mix, and their own internal changes.
And the call really hammered home that policy uncertainty, especially U.S. tariffs, EOC, tax credits.
Yeah.
It's not just talk. It's actively shaping their guidance, forcing tough calls on investments, particularly in the U.S.
Definitely. But despite those immediate hurdles, you heard strong conviction from management about the long game for solar and storage. Driven by demand, the tech advantages. They're shifting strategically towards profit, using storage as that key differentiator.
Okay. Well, that was our deep dive into the Canadian Solar Q1 2025 earnings call. Remember, this is just our analysis of the content. It is not financial advice.
Yeah, we encourage you to really think about those different forces we discussed. The short-term drivers pushing that Q2 guidance up versus the much bigger, murkier, long-term policy picture. How do those conflicting signals shape your view on companies trying to navigate this space?
Thanks for listening. We'd love to hear your thoughts or questions on the call or the sector in general.